Welcome back, learners, to the course on Essentials of Financial Management, Week 1, Lecture number 5. If you remember, in Lecture number 4, we discussed about the risk-return trade-off in financial decisions and the concept of financial planning. In this lecture on different forms of business organization, we are going to learn about what are the different forms of business organization and what are the different financial considerations underlying the choice of a form of business organization. So, let's start. Now, different forms of business organizations. There are several forms of business organizations, each with its advantages and disadvantages. So, business organizations can be considered under three broad categories. They have several advantages and disadvantages. First one is sole proprietorship, the second one is partnership, and the third one is company. We'll look into all these one by one in detail. Sole proprietorship. So, what are sole proprietorship form of business organizations? They are the simplest and most common form of business organization. If you talk about business organizations, sole proprietorship form is the simplest and the most common. That is, they are most numerous as far as the numbers are concerned. If you look around yourself, you will find a number of organizations of the sole proprietor form. They are most in numbers, but their receipt, the collective receipts or aggregate receipts is not that much. They are owned and run by a single individual. So, there is a single owner who manages the entire business, who looks after the entire business. No legal distinction between the owner and the business. So, there is no separate legal distinction between the owner and his business. They are considered a single entity. So, that is again a limitation as well, because owner receives all profits but is personally liable for all business debts. So, receiving a profit is good. Whatever the business makes, everything belongs to the owner. But there is no legal distinction between the owner and the business. So, all the business related liabilities are considered as owner's liabilities also. So, his personal assets are also at stake. So, in case something goes wrong with the business, owner's personal assets can be taken, right? Next is, what are the examples of sole proprietorship form of a business? So, here are a few of the examples. I think you can look at all these around you. Local bakery owner, a bakery shop which is manufacturing or making cakes, that is a kind of proprietorship structure. A consultant providing consultancy services, a photographer who is taking photography as a business, a tutor who is providing tuitions, a personal trainer who is providing services. These all are example of sole proprietorship of business. Now, what are the benefits or advantages of sole proprietor form of business organizations? First is ease of formation and dissolution. There is no difficulty as far as the formation of these kind of businesses are there, and even dissolution is as simple. Registration is not mandatory and anyone can just start with the business just by hanging a signboard in front of the business. You can start with this kind of businesses. Low startup cost. Startup costs are low because there are no registration charges. The legal and the technical formalities are also very low. So, in that case, the startup cost for these businesses is very low. Ownership of all profits, because there is only a single individual who is owning the business. So, whatever the business makes, entire thing belongs to that individual. He has the ownership of all the profits. Subject to fewer regulations. Unlike the corporations, your proprietorship is subject to fewer regulations. They are not being regulated as the corporations are being regulated, right? No corporate taxes. Profits are declared on owners' individual income tax returns. So, they are not subjected to corporate taxes, and whatever the proprietor earns from the business, he reports it as his personal income on his ITR, when he files his ITR. So, you know, when a person files an ITR, he has the 5 heads, and one of the heads is income from business and profession. So, whatever he earns from the business is reported under that particular head. Control, complete control over the business, because there are no other shareholders, there are no other partners, everything is being taken care of that individual. So obviously he has the complete control of the working of the business. Whatever he decides, he can do with his business. Now, what are the limitations of this kind of structure? Unlimited liability, and this is perhaps the most, you can say, the biggest limitation of this kind of structure. What do you mean by unlimited liability? Because there is no separate legal distinction between the owner and his business. So whatever the losses of the business are, it is actually considered as the losses of the individual, and his personal assets are at stake. Funding, because and only an individual manages it, he has limited access to funding. He can use his personal savings, he can take a bit of money from his family, his friends, or at max he can get a bit of support from the banks. But apart from that, he is not having much options to avail credit to support his organization. Continuity. Now again, there is question mark on continuity as well, because if let's say something happens to the owner, if the owner dies, so in that case the organization might close down. So there's a question mark, there's a chances that the organization might not continue for a very long period of time. Limited growth, since funding opportunities are limited, obviously the growth potential is also less in these kind of organizations. Now the next category of organization is the partnership form of organization. So what are partnership form? When two or more than two individuals come together to start a business, that is a partnership form of a business. Single individual, that is a sole proprietorship. Partners agree to share the profits or losses of a business. It's not only about having profits. Profits are good, but in case you are not having profits, you are having losses, the losses have to be also shared among the partners. Popular choice for the professionals like doctors, lawyers, accountants, as well as for smaller businesses. So partnership form of businesses, they are very popular among lawyers, doctors, accountants. Let's say you have few doctors, someone specializes in heart surgery, someone specializes in neurosurgery, someone is an ENT specialist. So they can come together and start a hospital. Different specializations they have, they can offer services to the patients. Similarly, let's take an example of lawyers. Someone is very good at civil cases, someone is good at criminal cases, someone is good at, let's say, matters related to the businesses or property. So they can come together and can start a law firm, right? Share expertise and resources. Different individuals have different expertise. So if they come together, obviously they can do something better as compared to a single individual. They can pool their resources as well. Partnership agreement, contribution, responsibilities and profit sharing. Now this is something which should be there, though it is not mandatory, but there should be a partnership agreement, and it should clearly state what is the contribution that the different partners are going to make, and what are their respective responsibilities, how the profits will be shared, and in case there is any dispute among the partners, how that will be handled. So these things should be stated in the partnership agreement. So we are continuing with the partnership. What are the benefits of this kind of structure? The first one is synergy. As you could see, 1 + 1 = 3. This is what synergy. The collective output is more than the individual outputs. If the partners are on the same page, if there is a synchronization in their work, right? If their efforts are collectively leading to something good. So that is what synergy is. So that if partners are working together, there is a mutual consensus among them. So that will lead to synergy because they have expertise, and collective expertise, pooling of resources will help them attain this synergy. Ease of setup. Unlike the corporations, which requires a lot of technical experts, partnerships are also easy to set up. There are no much complications. Shared resources and expertise. As we've already discussed, different individuals have different expertise. Someone might be technically very sound, someone might be good at finance, someone might be having very good communication skills, he can speak, he can communicate. So different individuals have different expertise and they can come together and can start a partnership firm. Subject to fewer regulations. Again, we are comparing this with the company form of organizations, which is under a lot of regulations by the government and the you can say the Securities and Exchange Board of India, but that kind of thing is not there as far as the partnership firms are concerned. pass-through taxation, pay individual taxes at pro rata basis. When I say pass-through taxation, it basically means that the whatever the profits that they're generating from the partnership firm, they are not imposed any taxes. There are no corporate taxes on that income, and it is passed straight to the partners, and they pay taxes on their individual taxes when they are filing. When they are filing ITR, again there's a head for income from business and profession. So they will show those income under that head. So there is not double taxation. We'll come to know about this when we move to the further slides, that what is double taxation. Now, what are the disadvantages of a partnership firm? Unlimited liability in most cases. Now, similar to the sole proprietor firms, partnership firms or the partners have unlimited liability because there is no legal distinction between the firm and its owners, right? In the coming slides. Potential for conflict. Now, there are a very high chances that the partners might not agree on a particular point. So, in that case, there might be conflict, there might be dispute, and if that happens, there are chances that they have to dissolve that partnership firm. Lack of continuity. So, let's say one of the partner dies or one of the partner is not willing to continue. In that case, the future prospects of the partnership firm is again questionable. Limited capital. If you compare it with the proprietorship firm, they have a bit more scope of generating or raising funds, but again the funding is limited because they cannot issue shares, they cannot issue bonds, they cannot issue preference shares and all those things, right? So again funding is limited, and so the growth prospects are also limited in case of partnership firm. Now let's understand the different types of partners. All partners in the business are not same, right? They have different sense of responsibilities, different kinds of contribution. So what are the different types of partners? The first one is active partners, also considered as the managing partner. So who is a managing partner? What is his role? Actively participates in the day-to-day management of the business. So he is taking active part and managing the day-to-day activities of the organization. So he is considered as an active partner, right? He is making the contribution in terms of finance, and he's also taking the responsibility of handling the operations also. What is his liability? Usually has unlimited liability for business debts. So managing partners or active partners have unlimited liability. That is, in case something happens or there are losses, his personal assets are at stake. Let's take an example for this. A senior partner in a law firm manages client relationships and also handles administrative tasks. So if you take an example of a law firm which has multiple partners, the senior lawyer will be overseeing the work of the junior lawyers. He will be managing the firm and also be handling the administrative tasks, right? The second category of partners is the dormant partner, also known as the sleeping partner or limited partner. I think dormant word you should be familiar with. Dormant, which is kind of inactive. So they are the sleeping partner or limited partners. So what are their roles? They contribute capital to the business but do not actively participate in the management. So obviously they are putting the capital, but they are not much interested in managing the day-to-day operations of the business. They are only involved in giving the capital support to the business. Now, as far as the liability is concerned, liability of dormant partners is restricted to the investment amount. So let's say a partner has invested 1 lakh and the firm has suffered a loss of, let's say, 5 lakhs. So their liability is up to the amount that they have invested, that they can suffer a loss maximum of 1 lakh, that is maximum to their investment. Their personal assets are not at stake, unlike the active partners or the managing partners. Example would be, let's say an investor who provides funding to a tech startup. He only provides funding, but he is not involved in the day-to-day management of that tech startup. He will be considered as a dormant partner. Now, we discussed about the types of partners. Now, let's discuss about the type of partnership. So, the first one is general partnerships. This we have already discussed. When 2 or more individuals agree to share the profits or losses of a business, that we have already discussed. Now, this is the simplest form of partnership, and this is often the default structure when multiple people decide to run a business together. So, whenever you think of starting a partnership firm, this is the default structure. This is the basic form of partnership. We have already covered this. The second type of partnership is the limited partnership, that is LP. So what it is? Two types of partners are there, general partners and limited partners. We already discussed about who are the general partners, who are the limited partners. So when we discussed about the general partnership, everyone was the general partner. But in this limited partnership, few are general partners and few are limited partners. So it offers a way to attract investors. Who are the investors? That is the limited partners, and who want limited liability and they are not interested in managing the business, right? So it is attractive to those investors who only want to make investment and they don't want unlimited liability, and they are again not very much involved in the day-to-day management of the business. So this is for them. Next category is limited liability partnership. This is one step ahead of the limited partnership. What it is? It combines the benefits of partnership with the limited liability of corporation. So it is something in between the partnership firm and limited liability company. So we know that limited liability companies don't offer the unlimited liability. The liability is limited there. So it is taking that feature from there. Partners are not personally liable for the debts and obligations of the LLP. So when we discuss about the limited partnership, there are few partners for general partners, few partners for limited partners. But in limited liability partners, all the partners are limited partners and their personal assets are not at stake. Liability is generally limited to their investment in the LLP, right? So we can take an example, the architectural firms, they have different architects, so they can be of LLP firm so that they can safeguard their architects in case some design errors are made, right? Company. So the third and the most prominent form of business organizations in which the businesses work in this modern era is the company form. So what it is? They are also called corporations. So we also use the term corporations. They are complex form of business organizations. Unlike the partnership or the sole proprietorship, companies are more complex because they are artificially created. A lot of legal and technical experts are required. A lot of amount has to be invested in the formation of a company. It is legally separate from its owners. Unlike the partnership and the proprietorship, company is legally separated from its owners. It is a popular structure for larger businesses. When smaller businesses are there, then proprietorship and partnership kind of choices are more popular. But when you are talking about a large structure, larger company, then business is the popular structure. Company is a popular structure. Account for the lion's share of aggregate business receipts. They are few in numbers, but when it comes to the aggregate receipts, they account for the lion's share. That is, they have the maximum contribution. Now, what are the benefits of a company? Limited liability. That because business and the owners are separate legal entity, they are distinct as far as the legal definition is concerned. So the owners have limited liability, their personal assets are not at stake. Raising capital. So the company has multiple options of raising funding, right? It can issue shares, it can issue debentures, bonds, preference shares, go to banks, financial institutions. So it has multiple options of raising funds, which leads to a varied investors. Perpetual succession. Perpetual succession means the company will continue to exist even if the ownership changes. So the shares might be sold from, it might pass from one individual to other individual, but that is not going to have an impact on the future of the organization. It will continue to work. So there is no change in the, as far as the future prospects are concerned, as far as because of the ownership pattern. Enhance credibility, because it's a more formal structure. So the people have more trust in that. Company has to report its financial statements regularly. So it has more credibility as compared to the partnership firm and the proprietorship firm, which operate in a more opaque manner. Ease of transferring ownership. If the company is publicly traded company, the shares can be easily purchased and sold. So the ease of ownership is there in case of a company. Now, what are the disadvantages of company? Complexity. Because a lot of individuals, lot of parties are involved. You need to involve legal experts. Registration is not easy. So because of all these, a lot of complexity is there. Compliance. A lot of amount has to be spent on compliance, that is meeting the regulatory norms. Operational cost. The operating cost of the company is also very high. The scale of operation is more. Double taxation in some cases. So this is what we discussed in the partnership part. So a company is imposed corporate taxes, and sometimes it might have to go through the process of double taxation. So what is double taxation? Company makes profit and it has to pay corporate taxes, which is around 25 to 35% rate in India on the profits that they make, and then they share dividends with the shareholders, and sometimes the shareholders also have to pay taxes on the amount they are receiving. So this is considered as the double taxation. Now let's move to the type of companies. There are two types of companies. One is public limited company and the other is private limited company. So let's delve deeper into this concept. So what are public limited companies? Public limited companies are voluntary association of members. That is, members come together to form an organization and it is artificially created, that is incorporated, right? So it is artificially created, so it has a separate legal existence, and here the owners and the company are two separate legal entities, unlike the proprietorship and the partnership form. Liability of the members is limited. We've already discussed ownership. There is a separate legal entity, company is a separate legal, so the liability of its members is limited to the amount that they have put into the company, right? Their personal assets are not at stake. Offers its shares to the public. So if it's a public limited company, so it can offer its shares to the investors and they can sell and purchase those shares to the stock market. Anyone can buy and sell shares on stock exchange that we have already discussed. Now, what are the characteristics of public limited company? Separate legal existence, right? Okay. So company is something different from its owners. It has a separate legal existence. That is the first characteristic. Number of members. For a public limited company, there should be a minimum of 7 members and there is no restriction as far as the maximum members are concerned. So if it's a widely held company, you will see a lot of members are there. There is no restriction. Free transferability of shares. So there is no restriction on transferability of shares because the company is listed in the stock market. So anyone can purchase or buy shares to the stock market. So that is one thing. Public ownership. The company can sell its shares to the public. So anyone can purchase the shares or subscribe to the shares and become the owner of the company. Stock exchange listing. So public limited company can get listed on a stock exchange and it provides liquidity also. Anyone can sell their shares and can convert it into cash easily. Strict regulations. Because it's a public limited company, the stake of multiple parties are there, a lot of shareholders are there. So in that case, it has to go through strict regulations, both from the government and the Securities and Exchange Board of India, that is SEBI. Limited liability. So the owners, they have limited liability, and the perpetual succession, because there is no impact on the future prospects of the company due to the change in ownership. So it will continue to exist. That is what perpetual succession is. Now, what are the benefits of public limited company? Access to capital. Because it's a public limited company, it can use stock exchange and can ask the general public to subscribe to its shares. So it has a lot of options to generate funds. So as compared to proprietorship and partnership, company has a higher or a wider access to capital. Enhanced visibility. So the company is listed in the stock market, so it gets more attention, it gets more visibility, a lot of news is being published regarding the company in newspapers on frequent basis. So visibility is more. Liquidity, as we already discussed, the shares can be easily sold, easily transferred, purchased, so it provides liquidity. Prestige, being a public limited company is a prestigious thing in itself. It gets a lot of media attention also. Huge capital mobilization. People trust public limited companies, they channelize their savings towards these companies, and these companies use these savings and make investments and then generate returns which are again passed on to the investors. So they are responsible for huge capital mobilization. What are the limitations of public limited company? Increased regulatory burden. As already discussed, a lot of parties are involved, a lot of individual stakes are involved. So obviously they need to be regulated. So a lot of regulatory burden is there and company needs to invest a lot to meet these regulatory guidelines. Loss of control. Sometimes the company might issue a lot of equity shares, and equity shares give the voting rights to the shareholders. So the existing rights of the promoters or the starting owners, they might get diluted to an extent. Public scrutiny, because it gets a lot of media attention. People expect a lot from these kind of companies as far as the dividends are concerned or the appreciation in the market price of the shares are concerned. So these companies are under a lot of scrutiny and it sometimes becomes difficult to manage that. Delays in decision making, because it's a multi-layered structure which includes board of directors, management and shareholders, and you need to bring everyone on the same page. You need to have a consensus among all of them. So sometimes some decisions might get delayed. Lack of secrecy. Legal requirements require them to disclose all relevant information. Public limited company have to disclose all the financial information, financial reports every year. They need to send their reports to SEBI also. So maintaining secrecy is difficult in these kind of organizations. Next is private limited company. So what are private limited companies? It is a voluntary association of not less than 2 and not more than 200 members. So minimum there should be 2 members and at max there can be 200 members. Earlier the upper ceiling was 50, but after the Companies Act 2013, it was further raised to 200 members. Still 200 members is a small amount if you compare it with the public limited companies. Their liability is limited similarly because it is an artificially created, it is separate legal entity, so the liability of its members is limited. Transfer of shares is limited to its members and is not allowed to invite general public to subscribe its shares. Now this is the distinction between a public limited company and a private limited company. The shares can only be transferred between its members, that is the 200 members that it has, and they cannot invite the general public to subscribe to its shares. So it is not a widely held company because the number of shareholders are limited in these kind of companies, unlike the public limited companies. Common choice for small to medium sized businesses, right? Now what are the benefits of private limited companies? Greater control, because limited number of shareholders are there, so they have a better control on the company. Less regulatory burden. This is not public limited company, so this is not listed on the stock market. So regulatory burden are less as compared to the public limited companies. Closer relationships, because the number of owners are less, so they can communicate effectively, can discuss with each other on a more regular basis. So in that case, there is a closer relationship. Perpetual existence, similar to the public limited companies, these are artificially created and the future prospects of the company is it not change because of the change in ownership, and the company will keep on existing and working. So that is why it has a perpetual succession. And the quick decisions, the last benefit is quick decisions, because the number of shareholders are less, there are not the multiple layers also. So in that case, if there is any decision, getting a consensus is much easier as compared to a public limited company. Now what are the drawbacks of a private limited company? Limited access to capital, because they are not listed on the stock exchange. You cannot invite the general public to subscribe to shares, so you cannot issue the shares, debentures. So getting funding is a bit difficult if you compare it with the public limited companies which have multiple sources to raise funds. Restrictions on transferability of shares, we've already discussed this. The shares can only be transferred between its members. If you want to transfer the share to someone else, first it has to be offered among the members, and if they give permission, then only it can be transferred to someone else, but it's a more complicated process. Less public visibility, because they are not listed on the stock market. They do not get that much of media attention. Their news is not published regularly in the newspapers. So the visibility is less if you compare it with the public limited companies. Now, what are the financial considerations underlying the choice of form of a business organizations? Whenever an individual starts off thinking of a new setup, so he has the multiple options whether he wants to go with a proprietorship form, partnership form, or over a period of time convert it into a company form. So the first point is taxation. So if it's a corporate form, the tax rate is around 25 to 30%, Whereas would be, let's say if you talk about the sole proprietorship and partnership form, their corporate taxes are not imposed and they are shown on the income that the individual is making and the ITR that they are filing. Liability and risk. So personal liability, in sole proprietorship and partnership, there is no distinction. So the personal assets are also at stake, whereas in case of the company form, personal assets are not at stake. Risk tolerance. The amount of risk that an individual is ready to or willing to undertake in anticipation of the expected returns is his risk tolerance. If an individual has higher risk tolerance, he might go with a sole proprietorship form of structure because it has unlimited liability, or he can go with a partnership. If he is not willing to take that much of risk, he can go with the company form of organization. Funding, access to capital. Partnership and proprietorship have limited access to capital, whereas company form has much broader access to capital as compared to the other forms of organization. Administrative cost. The setup costs are much higher in company form as compared to the partnership and proprietorship. Ongoing compliance cost is also more because a lot of regulatory norms have to be followed. So the companies have to spend a lot on these. Permanence of the form of organization. As you know, the company form has the perpetual existence, that the change in ownership is not going to have an impact on the life of the company. So they are more permanent form of the organization. Whereas sole proprietor and partnership might not have the permanent form. If something happens to a proprietor, if there is a dispute among the partners, then these form of organization might have to be closed down. And finally, the transferability of ownership. This is with respect to the private limited company and the public limited company. We have already discussed that. In public limited company, it is very easy to transfer shares from one individual to other individual through stock market. Whereas in private limited company, it has the restricted transferability. That is, it can only be shared among its members. And if you want to share it to someone else, you need the prior approval of the existing shareholders. So these are the suggested readings which you can follow to have a better understanding of all the contents that we discussed here. Thank you so much.